Hi viewers and friends, let me welcome you all on World Investor Week, World Financial Planning Day 2022. This is my organization, Astute Fincare Private Limited, and let me wish you all happy World Financial Planning Day. And my name is Amit Kachelia. I am the first certified financial planner from North Maharashtra, India, and I am taking this topic, developing your financial acumen on your own. Let me complete my drill of 3-4 minutes. Let me assure you that you all are in credible hands, because neither myself nor my organization nor my employees are associated to any financial product selling company. So basically we are not a mutual fund agents or advisors or insurance agents. So you rest be assured that we will be able to offer you unbiased training and impart unbiased knowledge. We are not here to sell any financial products. What's my integrity as your trainer then? You can visit the first website, india.fpsb.org, that is Financial Planning Standards Board. This is a certification body who has certified me to be the certified financial planner, and under Nasik City you can check my credentials. This is my official website, astutefincare.com, couple of my social networking handles. So I need to give this disclaimer that the views and opinions expressed in this presentation webinar are solely of myself and may not necessarily represent the views of FPSB India, and it makes no representations or warranties about the accuracy or suitability of the information provided by the webinar, but rest assured you are in safe and trustworthy hands. So what's our motto in taking this particular video? So our motto is that people should become financially literate under do-it-yourself mantra, because no country can sustain economic development or growth unless its middle class and upper middle class families become financially free or independent. See, now you need to understand that India has taken around 70 years from transiting from underdeveloping economy to developing to emerging, and we are yet to become a developed economy. Similarly, as citizens of the India country, we have transited from poor to lower middle class to now calling ourselves nowadays as middle class families. We are yet to transit to upper middle class or maybe the affluent wealthy families. And for that matter, without developing your financial acumen, that's not going to happen. So that's where this particular video can help you a lot. What's the new normal? So obviously we have seen the COVID scenario, that is the 2020-2021. And that has made us realize that people need to be more alert, more proactive, and act quickly and swiftly when it comes to their family matters, health and financial affairs. It's high time that they take charge of their finance in their own hands, treat their personal finance as their business, so that their financial goals do not get compromised due to external forces or external factors. What is this video's session coverage? So there are around 7 to 8 topics we are covering, right from way forward to approach, wealth, loan good or bad, secondary source of income, to early retirement, to discipline, and we'll be sharing few books for you to refer when it comes to finance and wealth creation. Now let's first understand what's the traditional approach people have been following. So obviously they have some extra money. Maybe the earlier generation was broadly mainly following this model, having some extra money, calling some agent or advisor, products being pitched or pushed, nothing to do with the goals of the family, the products being sold, and those were never being reviewed by neither by the advisor nor the family. So what's the more scientific, more logical approach to handle your personal finance then? You define your financial goals of the family. Okay, for example, buying a house 10 years down the line, buying a car 15 years down the line, for example, maybe retirement, and let's say child's marriage and so on. So these goals, considering the effect of inflation, needs to be calculated, so using some mathematical tools. So basically it's more about a destination based driving instead of just wandering around here and there. So that's setting your financial goals of the family. Analyze your current resources in terms of your assets and liabilities. So what assets you already hold in terms of, let's say, bank FDs, mutual funds, equities, and so on. What are the already liabilities you are liable to pay? The difference is called as net worth, either positive or negative. Third is a more technical step. so I won't be covering in this video. It's called as risk profiling and asset allocation. But yeah, these 3 steps are the feeder or inputs for the next 3 steps, that is writing your financial plan, executing your plan, and periodically reviewing it. So this is a more scientific approach of approaching your finance. Then only we'll be able to transit from middle class families to upper middle class, or upper middle class to more affluent rich families or wealthy families. Then only India will shift from or transit from developing oblique emerging economy to more of a developed economy. Otherwise that's not going to happen. Now what's the FP process, the financial planning process? As I mentioned earlier, there are only 3 steps you need to focus on. One is the financial planning phase. In medical analogical terms, we call it as, let's say, the pathological test. First you do the pathological test of your body, and based on that only you take the medicines or whatever medications you need to take. Second comes the execution phase, that is you diagnosed, now you take the medicines like surgery and medicines. So we call it as the execution phase. But this also needs to be keep on checking on a regular basis. That's why comes the third step, that is your periodical review. So planning, execution, and periodically reviewing it, let's say on a 6 monthly or annual basis. These are, if you stick to these guidelines, you are good to go from transiting from middle class to or upper middle class to the more affluent wealthy families. Now what's there is a purpose of life. So there is also purpose of doing financial planning. There are broadly only 3 purposes. You need to plan out your finance either to achieve the financial goals of the family, or to create wealth for your family, or to give some legacy for the next generation to be passed on. These are the only 3 reasons in combination or permutations combinations for which you need to pursue the process of financial planning. Now what do you mean by wealth creation? So wealth creation will happen for that particular family whose rate of return generated on a long-term basis needs to be greater than the inflation of that particular country where you live in, and the income tax paid on that rate of return. Okay, so I'll give example later on in my next slide. So your return should be greater than the inflation. Like in India, last so many years, the inflation rate is hovering around 6 to 8, 7 to 8% per annum. So your return should be greater than that, and also greater than the income tax paid on your returns. Let me give you an example. So now I'm sharing 4 different asset classes: gold versus bank FDs versus direct equities versus equity mutual funds. And this is data of past of India of past 31 years, right from 1991 to 2021. What gold has generated is, if you check at the bottom, 1 lakh somebody had invested in 1991, that 1 lakh in 2021, December 2021 end, it is becoming 1 lakh becoming 4.69 lakhs. So 4 lakh 69. So almost 4 times in 31 years, because the returns are fairly hardly 5%. So not beating inflation. So now what's happening? Middle class or upper lower middle class family will always remain lower middle class because it is not beating inflation. So real wealth is negative. And that's what is happening across India. If you see bank FDs, because it's 31 years of data, average rate of return of bank FD is 8.91%. Fair, good. It's 1 lakh becoming 14 lakhs in 31 years, so 14 times. But let's take the other 2 scenarios. As I mentioned, I'm not here to sell anything. Okay, it's a very unbiased opinion, but this is the reality check. We need to give it to ourselves. Direct equity, 1 lakh becoming almost more than half a crore, 53.30 lakhs. Why? Because the returns are 13.68%. So obviously it's beating 7 to 8% of inflation of India. Also you pay tax, still you are generating real wealth, positive real wealth. What about equity mutual funds? 1 lakh becoming just less than a crore. So one time you invested 1 lakh, it is becoming 96 lakh 69,000. So that's the difference between the first 2 assets and the next 2 assets. And that also widens the gap between rich and poor, and so on. See, as a middle class family, it is our responsibility, it is my burden to take care of my family. Whether it be, see, governments will keep on changing, whether it be X government, Y government or Z government, doesn't matter. My family, my responsibility, follow this model, and you will in future become a more wealthy family. Then only the country will become more wealthy. Now let's understand what is a good loan and a bad loan. Okay, and I'll be very candid when it comes to this. So first let's understand Loan taken to create an asset, and that asset later on generating some regular income flow is a good loan. So you take a loan, buy an asset, and you're generating some regular income out of it, it's a good loan. So obviously bad loan will be the opposite of this. That is, you are taking a loan in for a particular asset, but that asset is a dead asset, not generating any income. So then it's a bad loan. Okay. So let me give you a couple of examples in this. So good loan examples are, you are buying a loan to buy a real estate, and that real estate is rented out, from which you are generating some rental income. So good loan. You take a car and that you take a loan, buy a car, and that car has been let out, like Uber or something. It's a good loan because you are generating some rental income from the car. Let's say you take a loan to start some business like working capital or machine loan and so on. Good loan. But now let me be very, very candid. I'm stuck up with my first loan, which is a bad loan, housing loan, because I'm living in that house where, that is, I'm residing with my family, and to buy that house I took a loan. Right now I'm not getting any revenue out of it because I'm staying. It's a bad loan. Now obviously majority of Indians are suffering from this mistake, but that's what financial acumen, financial intelligence is all about. I'm trying to just negate this and try to exit out of this my mistake, because by the time I learned, I already made this mistake. I just hope after this video many people don't follow this. Second is a car loan. So I do have a car, but I have not taken it on loan. So car loan means what? You buy a car for your family by taking a loan, a dead investment, because you are not generating any revenue out of it. Third being, let's say, consumer durable loans, like festive season is round the corner, you buy televisions, washing machines, buy something, some EMIs or something. It's a bad loan. Okay, unless you're generating some revenue out of it, all loans are bad loans. So you need to understand this difference. All loans are not bad and all loans are not good also. Now, secondary source of income. So obviously people who are watching my video will obviously be having some kind of source, either they are into job or business or profession. Okay, but again that will make us just always remaining as middle class. It's high time that we shift to more into secondary source, and it's also called as moonlighting, that is doing some job in the evening or some later time beyond your job times. But obviously this should be within the compliance norms of your employer. Follow the guidelines. Like example, let's say your secondary source could be your passion. So you are, let's say for example, into job, but you're good at photography. So you can be a part-time photographer in some marriage event or some event planning and so on. Or let's say you're a good, you enjoy driving, you can become a Uber driver. I'm just giving some basic examples. Okay, like I am following my passion, and that passion got converted into a separate source of income as such, and right now I'm generating good source of income. Again, let me be very candid. I shared my mistakes, so right now also I need to share that I'm right now having 4 sources of income. I can't share the source of income, but yeah, I'm having 4 sources of income. So this is helping me out in trying to transit from the middle class to upper middle class as of now, maybe hopefully futuristically to a more of a wealthy personality or family. So secondary source of income is the need of the hour. It should be the new normal for everybody. You just can't rely on one source of income. Double engine. Okay. Now, what's about discipline? How do you handle your finance? So human life scenarios, I'm dividing into only 4 scenarios. The last 3 are all the negative side: disease, disability and death, which can happen to me. And the first being the most optimistic side. Now it's like hedging your life. It's a technical term. It means I'm just counterbalancing my life. What if negative happens? Again, my family is not financially being disturbed. Like supposing disease occurs to me or to my wife, I'm having medical cover along with some super top-up covers from some health insurance company. Okay. Second being, if some disability occurs, so physical injury or something resulting into my drop in income and standard of living because of that. Again, I should be having a PA cover, personal accident cover, separately. Third, if death occurs to me as a bread earner, I will be having a pure term life policy. Okay. So any negative event occurs with myself, I have hedged my family, protected my family. It's like a shield to my antivirus to my family. Okay. But obviously I need to be optimistic. I would like to live long life of 100 years and so on, nothing less than that. Okay, so in that case, all is well. Still I need to stick to the discipline of, I need to, from my sources of income, I need to save, I need to invest, keep on growing. Why? To achieve the goals of my family. We check the purpose of financial planning, right? So achieve the goals of my family, to create wealth and to leave some legacy for my next generation to pass on. So all is well. Also, still you need to stick your discipline matters. Now, what's early retirement then? This is new normal. This is across the globe, whether it be US, Europe, including India. People are now starting realizing that instead of working till 9 to 5 job, although there is no 9 to 5 job nowadays, it's more hectic. But even as a business model, so it's more hectic. So people are now realizing that 60 you retire and then you settle down and then you follow your passion. That's not going to, because there is no energy in you physically or even mentally to enjoy your life after 60. So better, why not retire at the age of 45, 50 or 55? Over there, the secondary source of income can play a big role. Your real wealth creation can play a big role if you develop this financial acumen at your early stage of your life. Okay, so what's early retirement? Now let me share, again be very candid. I'm right now running 45 and kind of I'm enjoying my mini retirement since last 4-5 years. I have all the time. I'm managing my 4 businesses. Apart from that, I do get time for my cycling, my mountain hiking and so on. So many stuff I'm able to do because of my mini retirement phase. I have my own personal targets of my early retirement and everything. And many people are thinking from this direction. But for that matter, you need to stick to all the things which I mentioned in my earlier part of the video, and that, trust me, will help you and guide you to plan of your retirement at the age of, let's say, 45, 50 or 55. There's no point retiring at 60 by the time, because you're already physically, because of the lifestyle, you're already physically exhausted, mentally blocked. There's no point in then thinking of some Europe tour or something. It's not going to work that way. You need, whatever belief system we have been following earlier, they need to be revisited considering the dynamics which have changed globally across the world. Now, what books you can refer to develop the psychology which I have developed in myself? One, you can refer this particular book, Goals by Brian Tracy. Of course, there are many books. Second, you can even refer, and these books are in physical form, PDF, even audiobooks are available. Many are also freely available on YouTube and everything. The Psychology of Money by Morgan Housel. Rich Dad, Poor Dad by Robert Kiyosaki. I'm sure many must have heard or read about this. My personal favorite is Think and Grow Rich by Napoleon Hill. And trust me, I'm having so many books. I'm learned everything. It's like in 3 Idiots, that jahan se gyan mila le lo. But see, many people say knowledge is power. According to me, it's BS. Okay. Applied knowledge is power. Whatever knowledge you get, unless and until you do not put in action, you do not put into reality, it is a waste. Okay. So whatever books you are referring, at the end of the day, and that's why I mentioned discipline is the key. Okay, financial discipline, health discipline, family discipline. If you apply this on a regular basis, creating wealth is like a catwalk. I mean, it's very easy. It's not a big deal. It's not complicated. It's achievable. The law of attraction will work for you. The universe will work, go behind you if you stick to the discipline part. If you still have any questions, we are here to clear your doubts. You can mention in the comment section of the video, or you can reach back to me on my personal mobile number or my email ID also. Okay, we do provide occasionally free counseling sessions also, financial counseling sessions and so on. Okay, so yeah, I'm available for you all. Thank you so much. Thank you.